To trade stocks, how to profit from relentless markets. Well, it's going to take a little bit of time, man, but we're back here. Day number 2. I think we uploaded yesterday, so daily uploads so far. I don't plan on uploading to this channel every day. By the way, it's just going to be too much once I start doing 2 or 3 gaming videos a day. But for now, we're back here. We're going to take it slow and steady. You know what I mean? Yesterday we talked a little bit about my experience with stocks and trading, just to give you a sense of like my credibility. I showed you my percentage returns, so I didn't turn $1,000 into 50 million or anything like that. But I do think I have a pretty good understanding of how to trade stocks. So hopefully I have some credibility in your eyes now. And today we're going to talk about how to analyze stocks, right? So the different forms of analysis that people will do, you will end up doing if you get involved in the markets, and sort of what you can expect from all of those. So fundamental, technical, and sentiment analysis. Those are the big 3. You thought it was LeBron, Wade, and Bosch. It's not. It's fundamental, technical, and sentiment analysis. So let's get into it. Slide number 1. I got to come up with a new fucking background, right? I think this one looks kind of cool, though. I don't know, on the PowerPoint. Okay, so fundamental analysis. This involves looking at a company's cash flow, its earnings, and its expectations for earnings in the future. So you have to keep in mind that whenever you buy a stock, you are purchasing a piece of a business, right? And what ultimately drives that asset price higher or lower is the fundamentals behind the business, right? Long-term driver of asset prices. So the cash flow, its earnings, and earnings expectations for the future. In the long term, that is what is ultimately driving stocks higher or lower. Now, nearly all professional traders, and I'm talking about people who actually work at hedge funds, on trading desks, at investment banks, will prioritize fundamental analysis, right? I would say 90% of their analysis is done through fundamentals, maybe 10% through technicals, right? If you talk to a guy who trades at a hedge fund or an investment bank and told him you use 100% technical analysis to pick stocks, he would probably laugh at you. You would probably be laughed out of the room, either for good reason or, depending on your knowledge of technical analysis, which we'll get into in a second, maybe he wouldn't. So some of the common approaches that you will see fundamental investors and traders use is trying to calculate enterprise value. You can Google how to make that calculation. It involves, taking the market cap of a company, stripping out the cash and cash equivalences, looking at the debt, and then trying to find stocks that are trading underneath their enterprise value and, selling it above. Another common approach would be a top-down analysis, which, if you think about starting from the top, you are starting with a world view. So looking at the macroeconomic picture, right? Looking at the huge picture, looking at what governments are doing, foreign governments, central banks, the sorts of decisions and laws that they are making, how this will affect, currencies for a particular country, what those moves in currency means for a certain sector, and which companies inside of that sector are in a good position to profit or decline from all of these things that are happening, from the government down. So taking a look at a big picture and then working your way down until you find a company that is in a good position to profit or lose money from those decisions. That would be a top-down analysis. You'll see a lot of people talking about that. Hedge funds mainly use top-down approaches. Bottom-up, obviously, looking at companies, their financial statements, and working your way up. That would be a bottom-up investment analysis. Okay, so that's fundamental analysis in a nutshell. I know that's a pretty quick explanation of what that is, but that's what it is. So moving on, technical analysis, parentheses, Wrong. I believe there is a wrong and right way to do technical analysis on stocks. What most people do is the wrong way. So, considered by many to be voodoo, doesn't work. You will hear many industry professionals, and you should listen to them, because if you think back to last video, something like, let's say 95% of like retail traders lose money in the long run, right? And 95% of retail traders, in my experience, use this form of technical analysis, and it's why they lose. I wouldn't recommend doing these things. So this involves using all of these indicators. If you've been trying to research technical analysis strategies online, you'll probably get a lot of this. So people telling you that they've found a certain indicator, they've got 15, 20 indicators on a chart. It looks like a fucking map of the Los Angeles freeway system. It looks ridiculous. The thing about indicators in stocks, so we're talking about simple moving averages, exponential moving averages. When you get like a platform and start doing this, you'll see all sorts of shit. Stochastics, RSI, MACD, Bollinger Bands, Keltner channels. There's hundreds of them. There's hundreds. But the thing is, most, if not all of these, I use maybe one or two technical indicators, and it's only to sort, it's like a cherry on top, right? I think of technical indicators as a cherry on top, kind of gives you a good feeling about a trade that you put on. It doesn't necessarily build that idea. You shouldn't buy something, in my opinion, because an indicator told you to. And that's because, for one, indicators are reactive. They're lagging. All my gamers, they're gonna understand this, the term lag. These are lagging indicators, and it doesn't help you predict what the price is doing. It's merely telling you what it just did, right? And if you want to be able to profit from stock movement, you have to predict price movement, right? You can't react to it. So indicators, I would stay away from them. We're gonna get into the correct way to do technical analysis. And here we go. Technical analysis, correct. So being able to look at price, right? Looking at a chart, if you've ever seen a stock chart, hopefully you have. If you haven't, you probably have no idea what the fuck I'm talking about. You probably already tuned out, right? But if you have, maybe you've already put on some trades, and then you know what I'm talking about. So being able to find support and resistance levels, the most basic of basic things, right? Support and resistance. Like I said, I'm not going to explain what that stuff is. If you don't know, just look it up. Reading and understanding the price action of stocks and how it relates to supply and demand. So if you've taken like an economics course, I'm sure you probably have, you understand supply and demand. That's what markets are. Markets are a function of supply and demand. And by reading price action and being able to see where buyers are, see where sellers are, and being anticipatory in finding potential supply and demand imbalances. That is where you profit from stocks. So being able to look at a chart with no indicators on it and saying, okay, here we go. This is where my buyers are. This is where my sellers are. This stock is buyer controlled. It's controlled by buyers. People are more willing to step in and support the stock. Or this stock is seller controlled because of where it's at. Every time it pops, somebody's going to be looking to sell it. So this is going to help you be anticipatory and be able to predict price movement. And ultimately, that's what's going to help you make money. You got to be in before the stock moves. By the time you look on mainstream media, CNBC, you see some fucking article about it, the move is done. It's already happened. They're doing that to sell it to you, right? So that kind of goes back to, for retail traders, this market trading stocks, it's not set up for you to win, right? That's why your broker wants you to trade all the time. That's why you see all these trading commercials. They'll lower their commissions, trying to get you to day trade. I see so many day trading commercials. If you watch CNBC, it's because they make money from your commissions. The more you trade, the more they make. So anyway, this is the correct form of technical analysis. And, we're not actually looking at charts today. So we'll actually get into what all of this means and give you like a visual. of how to do this stuff in another video. Like I said, I want to kind of keep these short, but this is what you're going to learn how to do, is be able to predict. That's correct. And then sentiment analysis. So this stuff doesn't come around very often, but this involves finding trades in which, you know, the retail crowd or even, you know, hedge funds and industry professionals are very one-sided on these trades, right? So it's very crowded. This also involves understanding crowd psychology, herd mentality, and how to bet against most people. Because again, if most people lose, you want to do what most people aren't. So this is sort of being a contrarian trader is what you'll hear it called. And this doesn't come around very often. Like I said, this more like recently. You'll see this happen like in IPOs when companies first come public. So most recently I can think of Snapchat, right? Everybody's got an opinion on Snapchat when it came out. Is it undervalued, overvalued? Are they buying it, selling it? What's the problem? Do I like it? Do I not? Snapchat, everyone was one-sided on that stock for a while. We ended up trading it and not super successfully. We made money on it, but not how we thought it would go. But this is maybe like 10% of trade, not even 10% of the trades I put on. Sentiment analysis. So those are the three. Which do I use? Price is king for me. The actual price movement on the stock, in my opinion, is really all that matters. Over the past 3.5, 4 years, I have seen undervalued stocks, stocks with low PE ratios or price to book or whatever data point or metric you use, low earnings multiples. Those types of stocks can stay undervalued. Like if you have some sort of website, you can look up stock charts now, like Finviz. I know people are asking me in the comments, like, what do I use to look at stocks? Finviz is pretty good to just look at stock charts. Look at something like Gilead Sciences, GILD, super undervalued stock, trades at like a 5 PE, something like that. Yet that stock stays down. It is not going anywhere. You know what I mean? And on the flip side, overvalued stocks can stay overvalued for a long time. One popular saying you'll hear is that markets can stay irrational longer than you can stay solvent. Right, or longer than you can keep money in your account. So if you so some of the best advice I ever got or heard was that true value. That's why I put undervalued in quotations, because I think that's relative. The true value of anything is what the next guy is willing to pay for it. Right? I mean, I got like a loaf of bread over there on my table, right? And right now you say, well, maybe that's worth $2.50. If a fucking nuclear bomb went off and nobody had food, my bread is now worth millions of dollars. True value is what the next guy is willing to pay for it. And if you solely trade on fundamentals, you are going to miss big moves. I'm thinking just this year, some of my best trades are in stocks that fundamental guys will not touch. I'm thinking Tesla, one of my best trades, Netflix. There is no case for those stocks on a fundamental level to be trading at where they're at, right? Extreme PE ratios. People have been shorting it all the way up, yet because markets, like I said, are a function of supply and demand, they continue to go higher, even though they are overvalued. And on the flip side, if you are 100% using technical analysis to pick your stocks, you are more than likely, sooner or later, going to step in front of a freight train. I'm thinking back to myself in 2015, not seeing the fundamental picture of why oil was crashing and all of the commodity-related stocks crashing with it, not seeing the big picture and stepping in front of that move, and it fucking sucked for a whole year. So I would describe my approach as 80% technical, 20% fundamental, and using, crowd psychology whenever the opportunity arises. So when stocks like IPO, everybody has an opinion and they're all one-sided. It doesn't come along very often, but when it does, that's what it is. And my best trades actually involve a mix of multiple forms of analysis and sometimes all three. So an example of some of the trades that involve multiple would be like Chipotle. Chipotle is one of my biggest positions right now. We'll actually look at the chart in the next video, but there was a technical pattern, right, in which I saw a supply and demand imbalance starting to be created, right, and I took it, and I know that I fucking love Chipotle. The business fundamentally is sound, right? It sold off, last year before last because they were poisoning people, but over the long term, that's a good business. Chipotle is a good business. There's activist investors involved there who are going to be trying and pushing the management to drive shareholder value. So that's an example of a trade of a fundamentally sound company that was also showing me a technical pattern that I love trading, and that's still something that I'm in. Like I said, it's one of my biggest trades. It's been working. It's now trending, and we'll get into like price discovery and price acceptance and shit like that later. So fundamentals drive long-term prices, right? If a company ultimately is losing money, burning money in the long term, and I mean very long term, that stock price will go down. Vice versa, if they make money, it will go up. But in the short and intermediate term, markets are still a function of supply and demand. I'd say most of my trades are on a 1 to 12 month time frame. If I do catch something where I see it, as being a smart investment, maybe something starts as a trade, ends up as an investment because it's working so well, then maybe longer than 12 months. But on that sort of time frame, 1 to 3 months, 3 to 6 months, supply and demand is ultimately going to win out, and you can't look at fundamentals on that sort of time frame. So that's why I choose technical analysis to pick and choose stocks. And then lastly, in my experience, the biggest and most predictable moves in stocks come after periods of volatility contraction, also known as consolidation. And like I said, we're going to actually see what this looks like. I don't know about y'all, I'm like a visual learner, right? So next time we're actually going to go into like some trading software, look at charts, and I'm going to show you how to identify these support levels, resistance levels, how to identify where there's going to be supply and demand imbalances, show you what volatility contraction or consolidation actually looks like. And not only what it looks like, because you'll see people like, shun technical analysis, and they'll be like, you're just putting some lines on a chart. It doesn't make any sense. But I'm going to actually explain to you what you're looking at when you draw these lines on a chart and what it means underneath the surface of what you see. But that's it today. Those are the 3 forms of analysis, sort of what I use, what I'm going to be trying to teach you. And that's sort of what you can expect. It won't be a slideshow next time. We're going to actually start looking at stock charts. Maybe we'll do that tomorrow. I got to stop doing my eyebrows so much. I've been watching too much H3. Okay, I think, that's it. All right, guys, so that's going to do it for the video here today. Like I said, Finviz, Finviz, if you want to look at stock charts, or you were looking for a place to find stuff. And we'll be back, if not tomorrow, maybe the next day. We'll see. I got to get back on this H1 grind and see if we can't get this win, baby. So thank you for tuning in. I'll see y'all next time. Stay frosty, stay cool. Don't fucking lose all your money doing some stupid shit in the stock market.